Welcome to another video on swing trading strategies. In this video, we will learn about advanced price action trading with Wyckoff trading strategy. I will show you how to apply this on Nifty, Bank Nifty and individual stocks. By the time you finished with this video, you will have learned how to use this Wyckoff trading method for swing trading and how to apply this trading strategy to identify high probability trades and to time your trades to perfection with well-defined entry, exit and stop loss. Wyckoff trading strategy discussed here can be used to trade in stocks, futures and in options. I have covered swing trading in great depth, and in case you have landed directly on this video, do watch the remaining parts of swing trading strategy series. Link to all those videos is given in the description box below and will come up at top end of your screen. So if you look at this Wyckoff trading strategy, you will find that there are 5 distinct phases in a range as categorized by Richard Wyckoff. Those phases are phase A, phase B, phase C, phase D and phase E. Now with these phases, there are terminologies used for various price action scenarios as well. I have included those price action points which are valid for our markets and have explained those in detail. For ease of understanding, I will take up each phase individually in detail and will then explain the various price related terms marked here on chart. The most common problem with trying to trade a range is that traders don't spend enough time trying to understand the details of price action within a trading range. With this Wyckoff trading method, I can guarantee you that your way of looking at trading ranges would change forever. Do watch this video till the end as I will be showing applications of same on Bank Nifty futures. Now credit to this method goes to Richard Wyckoff and Jim Ford for the schematics used above. I have added few things based on my own experience. If you want some resources on Richard Wyckoff and his way of trading, do let me know in the comment section below and I will name a few resources for the same. Apart from a simple chart, you don't need any other tool in this method. Charts can be accessed for free from tradingview.com and investing.com. So before we get started, there are some key terms I will be using in this video and let me explain those in less than 30 seconds. So when I say narrow spread, it means range of the candle, that is difference between high and low, is narrow. A wide spread candle with high volume would mean that candle is wide in nature and has high volume. A narrow spread candle with low volume would mean that candle is not wide and has less volumes. Also, a wide spread candle with high volume signifies strength of the candle. I hope all these basic terminologies are clear. I have tried to explain everything in a very simple manner, but I will still recommend you to watch this video 2 times today and then 1 time again next day. I always recommend this as this is an enhanced way of learning a new concept, and do not miss out on this Wyckoff trading method because it will change the way you trade simple price action pattern. So the first phase that we will begin with is phase A. So main characteristics of phase A are as following. So prior down move exists in the market. This is on back of strong momentum. Structure of lower high and lower low is clearly visible without any regions of consolidation. During this phase, first sign of preliminary support shows up, that is marked as PS. Now PS means preliminary support. I will be using this term throughout the video. So this support is typically in a form of a bullish candle that is high on volume and has a wide spread. Candles during PS phase usually have long tails. So this is the first sign that down move may be ending. So second sign of down move ending comes with a selling climax, which is marked as SC. Now these are the days when volume spike is clearly visible along with a bearish candle. So this day typically gives a feeling of more selling to come in near future, and sentiment is clearly negative on such days. So third sign of down move ending comes with automatic rally, that is marked as AR, which is this point of a range. Now during this, price actually rallies higher to form top end of this trading range. Price movement is very swift and is on back of strong momentum. This more or less extends to the region of PS, that is preliminary support. So take a note of selling climax as strength of down move on selling climax day aids overall recovery of price. The more intense the selling pressure is on the selling climax day, the more likelihood of lows holding out in market over the next few months. So the next phase that we will study is phase B. Now during this phase, you can spot secondary test where price tests the supply near the region of selling climax that we saw in phase A. Volume during this test does not expand and range of candle is limited in nature. If bottom is indeed formed in phase A with selling climax, then secondary test should confirm this with average volume and average price range. The panic that existing during phase A when the selling climax was underway would be absent during this phase when secondary test happens. This is a key differentiating factor and this should be taken note of. During this phase B, price faces resistance near the region of preliminary support and automatic rally phase. Now, role of phase B is pretty significant for overall range to develop. During this phase, price is in balance and there is equal demand and supply that exist in this phase. As phase B plays out, volume subsides and so does range of candles. At the start of phase B, volume is usually high along with wide range candles. So let us now take a look at phase C. Now in this phase, we usually get what is categorized as spring. This is when price violates the low formed during selling climax and then propels higher towards the resistance region of range. This phase is also when price retests the resistance level formed during preliminary support and automatic rally. Now once a spring is spotted, it is possible for price to do one more secondary test before heading higher. This is a shakeout phase that occurs during the end of the trading range. Volume activity during spring and secondary test should be on the lower side. If volume starts picking up and range of candles starts expanding, then this usually signals further down move in price. So do not forget this important aspect. Now phase C is the region where bears get trapped as price makes a new low. So this is where those who are short add to their positions thinking price would head further lower. But as price reverses and heads higher, short covering in some ways helps price even further. This is what causes price to move up with further momentum. Now there will be times when spring part would not play out and instead you would just get a secondary test. Such occurrences are common and should not be ignored. So let us now move to phase D. So the first thing that you will spot in this phase is marked as jump. So jump is when price will move above the resistance region of the range with volumes and range of candles seeing a noticeable pickup. Now at times when this range is breached, volumes won't expand, but in general always look out for spread of candle to widen and for volumes to pick up. This would actually signify strong presence of buyers within the system who are participating when the price is breaking out. The second thing that you will spot in this phase is marked as SOS. Now SOS means sign of strength. So once price moves above this range, you will now see price propel higher with wide range candles and increasing volumes. This is again a very important point. So the third thing that you will spot is LPS. This is also known as last point of support. So this is where price pullbacks into the previous resistance region to test demand and supply before resuming its move on the upside. This pullback should happen on low volumes and spread of the candle should not be wide. This is also the region where one must be looking to go long as price has moved out of the range and exhibited strength, and then it has retraced one time more to test if any supply exists around the previous resistance level. So this level, that is LPS, is a very low risk entry point, and we'll be discussing more about this when we start the section on entry, exit and stop loss. So this is phase E, which is the last phase of this Wyckoff trading method. During this phase, you see sign of strength by price along with last point of support. Now phase E is crucial as it repeatedly signals to trader about the underlying strength of price, which in turn can help trader be with trend till it finally gets over. Through last point of support, trader can assess previous resistance levels turning into support and hence can mark out relevant pivot points in order to assess whether trend is going to continue or to spot signs of trend reversal. Now, assessing the strength of trend in this phase is extremely crucial. Take note of three things mainly. Number one, range of candle. Number two, closing of candle towards the high point of the day. And number three, tail section of candle. All these are subtle signs of demand and one must pay attention to these in order to determine the probability of trend continuing. If you spot a lot of sign of strength candles along with last point of support price action, then odds are high that up move has begun and price will move higher with momentum. Pay attention to the angle of price rise and element of momentum. If angle of price move is greater than 60 degrees, then odds will be high for this trade to be a 1:3 or 1:4 risk reward trade. Important thing that you have to consider is that there are many variations of this Wyckoff trading range that may occur on charts. You will have to adapt as range forms and make use of your notes to label various phases in a range. I hope this particular aspect is clear. So now that we have basic understanding of Wyckoff trading method, let us now get down to specifics of how to enter, how to exit, and how to set a stop loss. Stay tuned as important aspects of this strategy are coming up. Now, entry in this method is very straightforward. You need to enter on signs of first LPS, that is last point of support. Now, this is a low risk entry point because this is where test of up move has happened and then price prepares for further up move. At times you will see that LPS does not form immediately after breakout of range, and this is mainly when momentum is exceptionally strong and price takes off in a vertical manner. To avoid such instances, you can enter 50% of positions once the breakout has happened on expanding volumes. This way, you would not miss out on any momentum oriented move. Now, remaining 50% of positions can be added when last point of support is tested. I hope this particular aspect is clear. So let us now move to the section of stop loss. Now, once entry is taken, stop loss for this method can be set in two ways. If you spot spring in the range, low of spring would be your stop loss. If spring is absent, then in most instances, low of selling climax would be the stop loss for the trade. If both spring and selling climax are present, then exit 50% when selling climax low is breached and remaining 50% when spring low is breached. So let us now move to potential up move once range is breached and all conditions are fulfilled. Now, the main advantage of this method is that you usually get 1:3 or 1:4 risk reward with this method. I have tested this method across Nifty futures, Bank Nifty futures, S&P 500 and some key stocks, and findings are pretty consistent across all instruments. Now, 1:2 or 1:1 risk reward is the base minimum that you get, and this is when volumes won't expand on breakout from range. Now, if this range represents 100 points, then you should expect minimum of 200 point as reward and more often than not 300 to 400 points on trade. This does depend on underlying market cycle as well, and also on volume and range of candles post the breakout. Now, do take a note of this point as this is crucial in assessing strength of entire trading pattern and will help you to potentially identify where to sell in a swing trade. If volumes and range of candle expands after breakout and price has an angle greater than 60 degrees, then odds are high for 1:3 to 1:4 risk reward for the trade. I hope this aspect is clear. So let us now come to the application of this method. I will explain this with Bank Nifty. I won't go back too much in history. Example taken is of October 2018 to 2019. Now, there are two things I will recommend here. Number one, take screenshots of all the slides, and number two, while watching the video again, take notes on your chart. In September to October 2018, Bank Nifty was heading lower with exceptionally strong momentum. Volumes were rising as price was falling and making a structure of lower high and lower low. So the first sign of preliminary support came in at this point, where a bullish candle formed with long tail on high volume. Remember one thing, you have to draw out a line from closing of preliminary support candle as potential top end of range. After few days then, you get a selling climax on high volumes. Volumes was highest at this point. Look at the candle on this day. Sentiment is clearly very negative, signaling continuation of down move. Couple of days later, you also got a secondary test. Look at the volume here, clearly on the lower side. From here on, price then rises and forms automatic rally region. Now this pauses at the resistance line drawn from the preliminary support region. Excess formed here marks the second range line. From here, price again retraces and forms a secondary test. It's important to know that spring stage does not form here and price instead forms a secondary test stage. And then it takes off to form the jump stage where price pierces the range on the upside. Now some variations therefore will exist, and your main aim is to adapt to how this plays out. If you see while breakout, volumes have not expanded either, and hence you should avoid taking trade right away. You should wait for the last point of support to form and then take entry. Post this, sign of strength emerges in form of strong candles and gap up price action. There's a second last point of support that forms to test out this region here, and then price moves above with momentum exhibiting sign of strength. So there are a couple of variations that have played out. Number one, lack of volume while breakout, and number two, spring stage was absent. Such variations are not uncommon. So range of price was 1200 points, that is from 24,200 to 25,500. Approximate movement was 1:1 risk reward as price moved from 25,500 to about 27,000. This was mainly because there was no expansion of volume that was seen when price broke out from range. This was something that we covered in the risk reward section. These principles of Wyckoff trading method can be practiced on any instrument of your choice. If range is formed over 2 to 3 months, then risk reward is much larger. Also note that if prior down move was strong and momentum oriented, then again this impacts this pattern in a positive manner. This method of identifying accumulation in range works really well, and do include this in your trading arsenal. If you want pointers on which time frame to practice this and which stocks to target for high probability trades, then do let me know in the comment section below and I will guide you in this aspect. Kindly consider hitting the like button and sharing this video if you like the content. Thanks a lot for watching this video, guys. Take care and be safe.